Welcome back, folks. This is the ITT Mentorship midweek review, and we're looking at the dollar index. So this is our daily chart. As you can see, we did get down into our order block in here, and we have mean threshold identified with this level here at 95.58. Came really close to it today with a low of 95.72, so very close. It would be interesting to see if it can get down there, but if we turn and start to trade back up into specifically this area right here, there's a volume imbalance right there. Now again, a volume imbalance is an absence of any bodies that close in a specific price range. Most of you are familiar with like this single candle here. Okay, we call that a buy side imbalance, sell side inefficiency. And whenever it has that one single candle that's designating one specific price range that's defined by the next candle's low and the previous candle's high, this is an imbalance of buying. So it's likely to see price offer sell side at a later time. And you see that happening with this one particular candle. See that? One candle delivers the entire range here that's imbalanced on the buy side. They rebalance it with one single candle here going down. That idea of imbalance to rebalance is the same thing that's being expected inside of this area here, but instead of one single candle creating a range that we call a BISI or a SIBI, sell side imbalance, buy side inefficiency, or SIBI, sell side imbalance, buy side inefficiency, or BISI, buy side imbalance, sell side inefficiency, that same idea exists here, but we don't have the candle bodies. We just have wicks. See, like this candle has a tail here, and this candle wicks through it. So between this candle's close and this candle's opening, there really isn't a body. Okay, there's no body there, just like we have it here. So we have volume imbalance there, and it trades back up into it. Now, they act like magnets. Okay, it draws price in. Now, these are more powerful than the buy side imbalance, sell side inefficiencies, or sell side imbalance, buy side inefficiencies. Okay, or liquidity voids. Okay, that idea is, it's okay, it's infantile in the grand scheme of things, but the more appropriate thing for you to train your eye to see are these right here, these specific signatures in price action. And once you see them, if you have a directional bias in mind, and next week we're going to be doing a lot on daily bias. So again, as a reminder, starting Monday, we'll be doing daily uploads to the mentorship. It's short term in nature. So in other words, I'm not going to be doing that for the, in perpetuity. I'm not going to continuously do everyday uploads, but for a couple weeks, maybe a month and a half, we'll do daily uploads. But next week's theme is daily bias, and I'm going to teach you some things with intraday volatility, so that way you can kind of like flesh out a little bit more of what I shared with the free content on the Optimal Trade Entry Pattern Recognition series on my YouTube channel. So as a brush up to get yourself prepared for next week, over the weekend, sit down and spend about an hour and a half or so and go through all of the videos that I just did on YouTube. That way you'll have the right frame of mind on Monday. But anyway, this pattern here of the volume imbalance and fair value gap is much more powerful than these big range candles, because this is likely to fill, but they don't always completely fill in. Okay, these we don't necessarily require them to fill in at all. It just needs to trade back to it, and it offers us an opportunity. So what do I mean by that? Well, we were looking for a weaker dollar, and you can go back and listen to the commentaries and see this is what we were looking for. When we trade down to these levels like this order block here, this could be terminus. Now, terminus is like the end of a price leg. It doesn't mean it's the bottom or low or the ultimate turning point. It just means that that's the end of high probability. And while it can still go down into the mean threshold of this last down close candle of the bullish order block, it could happen or it might not. And that's why we frame our trades or trade ideas with these specific signatures. They don't always pan out to their best case scenario exit or best case target. So in other words, what we're saying is we are likely to see the market trade sideways or choppy, may even want to come back up and trade up into this volume imbalance. Now, does it go there and then resume lower to hit the mean threshold or even run out that low? That I don't know. And to be quite honest with you, I don't really care if it does that, because we've had a lot of movement here on the downside, and it's not required, okay, that we demand that it trades down to these levels, because we have been participating in open engagement with all of these down close candles every single day, looking for higher prices in euro and cable. So let's take a look at a lower time frame hourly chart on this. All right, so there's the hourly chart on the dollar index. Now again, as I mentioned in the previous videos, we had that real gap. This is an actual gap that exists in the price action. We do trade up into consequent encroachment. Now again, anytime we talk about a gap, now a gap is this tail. We view that in my mentorship as a gap, and this is a gap because it's actually an absence of any kind of trading in there. And this, between this candle's opening and this candle's low, that creates a gap. This is a SIBI, sell side imbalance, buy side inefficiency. It trades right back up, fills it in, and then it breaks away. Notice this break here, and really no candles whatsoever. We trade right back up into the middle of it. It hits that and trades down, runs right back up into it again, consequent encroachment, midpoint, then it sells off. We have a SIBI here, sell side imbalance, buy side inefficiency. Price comes back up at a later time, fills it in, trades lower, one more time, returns back to what? This is those daily areas on your chart, or my chart, before we move down into the hourly chart. So by having it on your daily chart and dropping into lower time frames, it transposes all of those key levels into that lower time frame chart. So that way you're not confused, you're not surprised about all these things. Why is it reaching up here? Why is it reacting that way? Because you can see it and you anticipate these things because of it. Now when we reach down into that bullish order block, as we see here, the mean threshold level is just a little bit lower than that. Okay, and you can see how we tried to stab down into it, but it's not necessary or even required, as I mentioned a couple minutes ago. This right here, this could allow us to drive back up into this area here, and that's that area on the daily chart that I said that we would probably want to revisit, and that would clean this up. In other words, all this big down move on this single candle, not that it's a lot of pips, but it's a extrapolated move to the downside on that one single candle. And while it traded back up to that level here, and that would represent to this point here on that candle, it still has relatively that much room to potentially fill back in. So in other words, what am I saying? It could potentially trade back up into 96.65 to 96.70, and that could create some short-term selling pressure for foreign currency tomorrow, or overnight into tomorrow, or going into Friday. So what I'm trying to indicate here is try not to be overzealous with shorting dollar and getting long foreign currency at these stages. Demand a lot more clean, pure price action to frame that setup, because we've already done a lot on the downside for dollar, and we've had a nice run on euro higher, and cable has finally spread its wings and traded up into our target as well. When we go to that pair, you'll see. But I want you to study this chart here, okay? And there's a lot more things that I'm going to talk about in the weekend review, because there's a little bit more price action lesson there, whereas we're just really reviewing here. I also, for homework, I want you to write down what it is that you're trying to frame out as your bread and butter setup. Now, all of us want to do mega trades, capture 1,000 pips here, 10,000 pips there. That's all great, but what is it you're trying to do that is your main staple? This is the flagship of your career as a trader. What's the thing that you want to be excellent at? Is it trying to find that intraday trade in New York? Is it that weekly one shot, one kill? Is it short-term trading that takes maybe 2 weeks to pan out, maybe going into swing trading? Whatever that is, I want you to really take some time over the weekend before we do our weekend review. On Sunday when I post that, I'm going to talk a little bit about that too, and how we can start working towards those goals. But let's drop down into a 15-minute time frame for Dixie and wrap this up and go over to Euro. All right, so here's the 15-minute time frame on the dollar index. You can see here's Wednesday's trading, yesterday's trading on Tuesday, and then Monday's trading here. So we had Sunday's opening. We rated the relative equal highs here, hit that, came back up one more time. Again, it's not that it needs to run this high. Okay, remember these rectangles, these boxes, they're not supply zones, they're not demand zones. It's not none of that stuff. Okay, it's looking for periods of time where there's an imbalance in price action, and the algorithm that delivers price, it goes back to these levels to act as a opportunity for those individuals at the bank level, not your mom and pop bank, not the people you're going to meet on social media and people, I'm a XYZ desk trader at so and so. Those people don't know what I'm talking about here. I'm talking about the top tier banks. Those traders, they're waiting for these opportunities. It's not that they're buying pushes the price up. The algorithm is running and spooling out to this level. In other words, spooling is where it does this. It runs one direction, and it goes to a specific area, which is that box that's shown here as I outlined on the daily chart. Go back and watch, especially if you are new here, go back and watch the last few videos, and you'll see that we're actually talking about these types of levels on the daily chart, and then I'm commenting about that on Twitter, saying it's returning back to these levels, it's going back to the imbalance, it's then reaching for our targets. When price does these runs like this, this is where the traders that are in the know, they participate, they engage there. And when the market starts to react, when we see this reaction, the only thing we have to do then is identify where the imbalances are or where the order blocks are. And it's as simple as that. And when the market starts to break down, we have an up close candle here. It trades lower, extend that out in time. Here's your bearish order block, and then it trades aggressively lower, cleaning up all of this run here. And then there is sell side liquidity below this low and this low. Look how fast it attacks it, because it went to a point where the interbank traders are entering here. The liquidity over here is what they're going to eye up on. So this is where they short, where they want to cover. At 10 pips, 20 pips, or because it's moving really fast, they want to get out? No. They see the liquidity that's resting over here. How do they see it? Is the algorithm seeing your stops? No, they don't. They don't see your stops. It's referring back to an area because it's running on a program. Okay, it's autonomous. It's going to this level here because it's shown a rally in the past. So it's remembering. This is what a PD array is. The array is this low, and because it's programmed to understand that this low here, traders are going to see that this as a support level. This is trusting the support because it's higher than that low. Everything that's in the textbooks is wrong. It's training you to do things incorrectly. So below this low is sell side liquidity. That means there's people that want to sell at a low price relative to the point when price was here. So the interbank traders trade here. They short. They have to buy it back to get out of their trade. So they're going to look to buy below this low over here. Well, who are they going to buy it from? Those individuals that have a sell stop below here because they bought it, and now they've seen it rally here, so they think that that is a support level. So their stop is going to be at that low or just below it, and it aggressively runs there. So when it runs there, it hangs out below this low. So below this low, look what it does. It runs and then hangs around underneath it. That's not that it's, here's a support level, broken, now act as resistance. That's what it's given in the retail books. That's not what that is. It can be called that, and everybody can subscribe to that view and believe it, and that's great. Okay, but it doesn't answer all of the additional questions that will arise if you subscribe to that theory or that perception of price action. The liquidity now has been basically purged. So it's now, what's the algorithm doing? Is it going up to this low and saying, okay, this is a resistance level now? No. It's going back to a point of where we have a fair value gap. This candle's close, this candle's high, that small little portion of price action right in there, that's where it's going, right up into that. What's the close on this candle? You'll look at it right here, okay? The close on that candle is 96.46. What's the high of this candle right here? The open is 96.46. It's not this candle's low here at 96.44. Oh, you're arguing semantics, Michael. No, I'm telling you what is actually happening. This is what the algorithm does. It's not just close, it's perfect. Okay? It's perfect. So when you see these things and you understand what is it actually doing, then you can anticipate what price is likely to do next because you've trained your eye to see it over and over and over again. When it trades down into our lower level objectives, then we have to anticipate the likelihood of lower probability trading conditions, maybe even a reversal, or a prolonged consolidation. And then add to it, today was FOMC at 2 o'clock. Look at your economic calendar. And I use the Forex Factory economic calendar, by the way. But you can see today we went lower, and now we're just chopping wood again. So we're back into a consolidation. These price points here, where we return back to the fair value gap there, and after purging the sell-side liquidity, so the sellers, they have been purged. They are stopped out. They're not looking at that trade as a let's get short. They're stunned. They're scared. They're not looking to participate now. Smart money knows that we still had that bullish order block on the daily chart at that level here at 96.10, and potentially the mean threshold of that bullish daily order block, which is 95.58. Now, again, if you're new, go back and listen to what I said about the daily chart, and that's what these levels are, okay? But having them on your daily chart and then dropping down the lower time frames, all this stuff becomes much more clearer. Whereas if you didn't have it at all, it's literally like you don't know what you're looking at. It's all noise. It seems noisy. It seems disjointed. Like there's no real rhyme or reason as to what price is doing. But if you look at these points in price action and then directly tie them to the relative lows in euro or cable, which is British pound versus US dollar, then you'll see what has been eluding retail traders all this time, which is clarity from institutional order flow. So let's go over to the euro dollar. All right, so here's the euro dollar. This is our daily chart. And we passed one more time through the mean threshold of the last up close candle, which is our bearish order block. We did stab through it. And depending upon if we go deeper on that dollar index, if it needs to trade down to its mean threshold, if it happens to occur, I think they'll extrapolate the euro dollar to take out this high. The next levels that are important here, we're going to remove the mean threshold and move to the rejection block. All right, so this is our rejection block here, which is the last up close candle's closing price. The algorithm seeks that price lots of times when it trades back to a swing high without running the swing high. And I already know what you're thinking. You heard those words. When it goes to a swing high but doesn't run through it. A lot of you new students are thinking to yourself, all right, that's what I need to know. How do you know, ICT, that if it's going to go up and not run the high, or if it's going to run the high for a turtle soup? We talk about that in the mentorship. Okay, but there's other supported lessons that needs to be learned, and you need to delve into those before you understand and have a clear understanding of what makes a low really a low for the near term, and that way you can trust that it won't. Like for instance, like this swing low here. When price was starting to dive down here, how do you know that this low wasn't going to get violated and it's just going to come back down into this BISI? First of all, it's number one, it's experience, and two, the break-in market structure, the fact that I actually outlined all this stuff here, saying if it went down, I would take it below this low here and then send it up above here, and then ultimately see if we can get up to these levels. And it's all in recording. Like I can't go back and change that. I have to co-sign every single time I talk to you. So whatever happens, happens. Either I'm right or I'm wrong. I'm not 100%, but go back and see. I'm recorded. So the logic behind whether a high or low is going to be kept in the marketplace without being violated or taken out has a lot to do with the underlying narrative on a higher time frame basis. Now, to me, it would make no sense whatsoever for Eurodollar to stop right here and not at least run the rejection block. Okay, so in your notes, you want to be writing this. Even if this high isn't taken out, 80% of the time, it does trade above the rejection block. That's the nature of what it is. It rejects. Now, it makes no sense for Euro, to me, to go to this level here and not at least run the rejection block. So, in your notes, whenever you're looking at old highs or old lows, you want to find in the swing high, you want to find the highest up close. You don't want to look at this. Okay, it's the closing price of the last up close candle, or the highest up close. Draw that out in time. That's your rejection block. Now, even if it does not run this high here, you have an 80% chance that it will likely trade to that rejection block, which is the price of that closing on this candle here. So in this case here, it comes in at 114 and 46 and 8 pip bets. So we'll just call it 46. It's likely to trade above that, and it doesn't have to take out this old high. So that's the importance of understanding why I teach the rejection block, because I don't care if it doesn't run this old high. I know that the rejection block is very likely to get traded to, and even if it does take out this high, it's still a target for me. Now think about it like this. If Eurodollar trades up and goes above the rejection block, and I take something off my trade if I'm long, am I going to be upset if it never gets back above this old high? No, because I've paid myself along the way and ultimately traded above an area of old institutional order flow. The institutions rode this down. So this high here, they don't require a run above this high. It's nice to see it happen, but it doesn't have to happen. There's many times you'll see that if you study it, the rejection block is really all that's required. And I'll give you an example. Down close candle in this swing. Okay, the closing price is 1.07 and 77 and 5 pipettes. The market trades down. Does it take out the low here? No. Does it even take out that candle's low there? No. It trades below the rejection block there. Does it there? And it does it there. Okay. This candle's this candle's close comes in at 1.0794 and 1 pipettes. It wicks through it here, but doesn't take out the low. It wicks through it here, but doesn't take out the low. It's trading to the rejection block. That's what makes the rejection block what it is. That's why I named it. It does its very thing. Here you go here. Look at the close here. 111.72 and 9 pipettes. We trade to this candle's high at this candle here. You trade to 1.11 and 75. So it's above the rejection block here, which is 111.72 and 9 pipettes. The high on this candle, 111.75 and 7 pipettes. Does it blow out the high? No. The high is 111.79. Rejection block traded to here and here. Then it trades lower. So that's the importance of having the understanding of a rejection block. It's not crucial, it's not imperative that you understand if it's going to run an old high or not run an old high. You do benefit by knowing the rejection block within the swings, because that's the highest probable target, not running the old high. Okay, so there's so many things that has to go along with that concept to flesh it out, but right away you should have something written in your notes pertaining to rejection blocks and old highs and old lows, that's a very high percentage of a level that could be traded to, and that's your target. So what am I saying there? Let's assume for a moment you're long from here or any of these candles going up, or even from here, okay, trading into the fair value gap. If you're long 80% of your position should be off at that rejection block. And then you only have 20% of your original position on to see if you can catch a runner that takes out this high, because it might not do it. But it's very likely, not 100%, but it's very likely that this particular price level does get, in fact, traded to or above. Okay, so really critical information there, but nonetheless, it doesn't make any sense to me personally why we would stop right here and not at least run that rejection block, if not take out the entire high altogether. So let's drop down into the hourly chart. All right, so here's the hourly chart for the euro dollar, and you can see, oh man, what a beautiful run back to the order block there. Sell side liquidity, relative equal lows, fair value gap, down close candle. Which order block do you buy, Michael? When it's a bullish order block, the one that has a fair value gap and liquidity. So you can see it beautifully traded there. That's actually an optimal trade entry too, and it's rated the relative equal highs here. Now also, okay, for those of you who've been here for a while, and if you know that I've mentioned this recently, and I don't recall exactly what video it was, but I think it was within the last 3 or 4 of them on my commentaries, and I talked about the relative equal highs. Whenever you have the second high here relative to this one being higher, and if you have a fair value gap, that fair value gap will be a speed bump before it runs that high. It can run that high, but it's likely to have a retracement or a pause, and that fair value gap extended out in time. Look what it does here. Hits it, retraces a little bit, and then it finally pumps through it. Sometimes these retracements can come back a little deeper, and had it been another day except for FOMC like we had today, it could have very easily came back down and traded this BISI, buy side and balance, sell side efficiency, could have rebalanced that and then sent it higher to take out that high. So this is one more signature proving that what I'm talking about, these are my signatures, okay? With IPTA, which is the interbank price delivery algorithm, it's coded to know these things. It's part of its logic. So when it looks for what I'm teaching you to see in price action, it's not contrived, it's not fluff, it's not made up stuff. Okay, these are things that repeat over and over and over again. And when you understand them, it builds a great deal of confidence. Now, again, I do suffer losing trades. I do miss moves because I'm demanding something that doesn't just get dropped in my lap. For instance, a limit order may not be filled because of a spread, or I may sit down in my charts because real life got in the way and I missed the actual entry. Even a secondary entry, which, there many times if you look at a trade, it gives you opportunities to still get in it before it goes to an objective or a target. And there's no association with that as chasing price, because where I teach you, for instance, the institutional order flow entry drill, that is a entry technique that is after the ideal fill would have taken place, or entry technique. Okay, in other words, entering at a order block or entering at a fair value gap, okay, or a run above old highs or below old lows to take the stops. That's your real entry. That's what you want to focus on there. But for some of you in this mentorship, you've learned the order flow entry drill technique where you get in after the real move starts, and it's not chasing price. It has nothing to do with chasing price. You're actually participating with the order flow, and you get immediate feedback from those entries. You're not waiting around. It usually goes through your fill and then runs the other way, and that's what you want. Contrast that with trying to get in below old lows. Sometimes it can go a little bit deeper than you wanted it to, and that's all part of the experience that you're going to gain by doing practice. And you can't go around that. You can't shorten it. You have to endure it. You have to go through it, and it's not fun right away because you don't know exactly what you're doing. You don't feel comfortable about what you're doing. And that's part of it. That's the growing pains. But nonetheless, this pair looks as if it could still drive up into that 114.50 level. And that will be another level to watch. And above that, we have the 14.97, which basically, to me, is 115 big figure. So does it have the legs get up there? I don't know, but we certainly could see it trade up into that 114 mid figure and clear the rejection block. Let's drop down into a 15-minute time frame. All right, so here's the 15-minute time frame for the euro dollar, and this is all FOMC right here. Okay, so this candle right there, it's 1400, which is 2 o'clock in the afternoon, New York time. and that is when the FOMC announcement came out. So notice what they did. The candle opens at 2 o'clock, trades down. Why is it doing that? Well, what has been going on? The market's been going up. So before it makes an extrapolated move higher, taking out the previous high here, it takes out those individuals that are long through this consolidation. So anyone that was buying any kind of retracements in here, they get dashed on the rocks right there. And what is it reaching into? This. This is a buy side imbalance, sell side inefficiency. We abbreviate that with the letters BISI, BISI. Now, if we look at what that range is, it's here and here. Okay. Now, notice what happens. We trade down into it here and we rally. We trade down into it here and we rally a little bit. Down into it again. It's slowly going sideways one more time. This is accumulation. Okay, this is accumulation. The market rallies up, clears this high, so it takes that liquidity, then rebalances all in here. This single candle is the same thing that this candle is. It's a buy side imbalance, sell side inefficiency, a BISI. The bias, remember, think back what we were talking about in the previous recordings in the dollar. We were looking for dollar to go lower. So when you're looking for setups, or if you're practicing and you're trying to train your eye, or if you're looking at it in hindsight like we're showing you here, it does not reduce its efficacy because it's showing you proof of the things that you're learning in the core content of this mentorship and the commentaries I give you twice a week. The underlying accumulation that's happening here, it's about, they're buying more here, they're buying more here, they're buying more here, they're buying more here. Who's buying? The banks. And the market rallies up. Whenever it starts to show these price runs where it's 1, 2, 3 single candles and it's real big ranges, the public thinks, wow, this is time for me to get in there and start chasing it. And that's not what's going on the bank level. The bank level traders are looking over at where the old highs are, and they're distributing their longs above this high here. And that's what you're seeing here. Until it retraces back down. They're not always shorting here. They're waiting for the algorithm to deliver price back to a point of rebalance. And then they're accumulating longs here. And then what are they doing? They're offloading it there. Not all of it. They're not doing it like that all the time. But they're paying themselves. So not only they're acting as counterparty for global commerce, but there's a division in the banks where they do these types of speculation, but they work mostly on one side. So it's in a buy program, the euro dollar was, and what that means is if we're bearish dollar, foreign currency should rally. So their focus is really looking for areas like this to buy. Now they could be shorting in here, but that short could really just be in the context of providing liquidity for global commerce or providing liquidity for a buyer. Okay, so somebody that wants to buy the breakout, they sold that to them and they're offering that liquidity. But they're not concerned because they have deep pockets and they know ultimately where this price is going to go. Again, I'm not talking about UBS. I'm not talking about Citi. Those guys are just as well as you are looking at charts, trying to figure out what's going on. They're trading on things that you're not learning. You're learning things that actually drive the market higher and lower here. Same premise here. When the market comes back down, more accumulation, they offset that with the liquidity that would be above this old high. That's why you see this run here, and then it drops back down into what? An order block. Picks up more orders, runs where? Above the high. So they distribute there again. So they're buying in here, selling above an old high. They're buying in here, selling above an old high. They're buying in here, selling above an old high. There. Okay. Then we get closer to that 2 o'clock time frame. The market gets real uncertain. Distribution, it's not because they're selling. This is not happening because they're selling short. It's not selling pressure. It's not the sellers are taking over the marketplace. It's not a lack of buyers. It's the algorithm repricing to these levels. Relative equal lows, we trade down below that. We start to rally up, and then 2 o'clock hour opens. So what's the market likely to do? If it's going to take traders out, they're long now. clear all these up, go deeper into this range. I teach this range has 3 specific price levels. It's not willy-nilly zones, okay? We're not looking at a zone and scratching our head trying to figure out, okay, what do I do inside that zone? We're not supply and demand, okay? There's 3 specific price levels. It's the premium end of the BISI, the discount end of the BISI, and the consequent encroachment, which is the midpoint, okay, the midpoint of that gap. This is an imbalance or a gap. So we find the midpoint of that. And the 50 level is I got to make sure I put it on an area because it's set to that magnet on TradingView. There you go. Come on. That's good enough for government work. All right, so we have the 50 level right there, and the actual price level is 113.22 and 4 pipettes, and the low comes in at 113.22 and 8 pipettes. So it was only off by 4 pipettes, trading down to the consequent encroachment. Now, again, for the folks that are new, maybe you're familiar with supply and demand. This isn't supply and demand, folks. Okay, it's not. It's literally like this all the time. I don't change the rules. I don't try to blur the lines to make it look like it perfectly fits, because it's not. It's not a con job. Okay, I have people in this mentorship that are absolutely killing it now because they understand how to see these levels. Now, if you go to other mentors, okay, they'll tell you that this is an imbalance because they've heard me or Chris Laurie or other people, and they'll say, okay, it's going to fill that in. And they may be looking to buy down here once it fills in. Well, I don't want it to do that. I don't want it to do that. I want it to trade down to the premium end of it, and that could be my entry. And if I can get this level 2, I'll buy it. I'm not waiting for it to come all the way down here, because it's better if it doesn't. Because it acts as a real indication that it doesn't need or want to come that low again. So if it doesn't want to go that low, what is it really stating? It wants to go higher. Where's it going to go? Well, this was the old high. So what's this high? The high comes in at 113.89. We'll just call it 113.90. So what's 10 pips above that? 114. What's 20 pips above that? 114.10. And what's the 30 pips sweep that we look for? So there's grades of sweeping above high or old low. It's in the grade of 10, 20, and 30. So 30 pips above this high, and we're assuming by rounding it, because it's 113.89.6, or basically 113.90, 30 pips above that would be what? 114.20. Here's 114.20. What's the candle's high here? 114.22 and 6 pipettes. Certainly gives you an opportunity to get at 114.20 institutional, doesn't it? There's no randomness. There's waiting. There's understanding what you're looking for and either engaging or waiting for the next one. They're like buses, folks. You're not just wait for it. If you miss it, wait for the next one. They occur every single trading day. Some larger than others, some more profitable than others. But they're always there. There's always an opportunity. You're learning so many ways to skin a cat in this mentorship. It's important for you not to rush, because if you try to rush or try to press yourself into one specific idea or style of trading, when you get to another level of trading information in this mentorship, you're going to be like, wow, that's better than I thought it was. And you're always going to feel like a kid in a candy store. And just relax. There's so much for you to learn here, and all the lessons end next December 2021. There's no more new lessons. It's just going to be me reviewing things. That's it. So pace yourself. Try not to get so overzealous that you want to jump to the next thing or try to rush in there. If you're going to be trying to trade with live funds, I'm telling you right now, because there's a huge amount of you people that came in here that are new, okay? Everyone that fails here does this. They see something in these lessons, or they hear me say something in the commentary, and they go right out to their live accounts and they put live trades on. And the only thing you're learning by doing that is learning to be fearful about what if it doesn't work. And you're going to be worried and panicked all the time. And God forbid that it actually doesn't pan out. It's going to mar your trust and your understanding and your progress here. Take the money out of it. Learn how to read price. Once you read price correctly, you can't imagine how it is to be able to sit down every single trading day and say, oh, I see what that's doing. It's going to go to here and it's going to go over there. And that's what you want to turn this into. It's a game. You want to see where it is, where is it going? Where is it and where is it going? And if you do that consistently over time, you will see how many pips are available to you. And then go back to that same analogy all the time. 25 to 30 pips a week retires anyone. And I don't care what you start with. You can have an account that's $25. Slowly grow it. Anyone, even with a low-wage salary job, can add more money once they're confident that they can finally harvest 25 to 30 pips net every single week. You don't need a job if you can do that. You don't. You absolutely do not need a job. But right now you do. And the number one job is not the one that's paying you, but the one that you're engaging in here, learning, because this is recession-proof. It doesn't matter who's the president. It doesn't matter if you're in a country that's poverty-stricken. It doesn't matter. All those things are external circumstances. You are in control of yourself and your destiny if you give yourself a real chance. And the only way you do that is being extremely patient and don't trade with live money. Learn what you're doing here. Once you understand how to engage this price action, the world becomes your oyster. So let's roll over to cable and wrap this video up. All right, so here's the British pound versus the US dollar, or cable, and this is the daily chart. And we finally arrived at our objective, or my objective rather. I talked about this particular candle here a couple weeks ago. I said that if I were running cable, I was making the market for it. We had this buy side imbalance, sell side inefficiency in here. As I mentioned last video, why didn't this fill? It's because we were looking for that breakdown in the dollar index, and it's not required for it to come all the way back down and close that in. So what would it likely do? Just trade down below that candle and then trade above the relative equal highs, or Candyland as I teach on YouTube. Then we had the breaker. So we had multiple things here that would offer an upside objective. We have the rejection block, which is the highest up close candle, the relative equal highs, then the breaker. Right away you're thinking, well, which one do I use, Michael? All of them. Each one of them are offering you an opportunity, if you're long down here, to scale off at the rejection block, above the relative equal highs, at the breaker. Well, what about this breaker? Doesn't it make it going to go down? If you look at Twitter, everybody's like, oh, I'm waiting for it to sell off now. It's going to that breaker. That's the difference between watching my videos, okay, and being trained here. The mentorship is me showing you where things fit together. I've demonstrated things conceptually, but that's not the same thing as teaching what it looks like in real time before it happens. So while this is a breaker, I didn't say it's going to hit that and go lower. I said we're going to see how we can trade into it and then eat into this tail of this candle, which is a gap. We split that in half. That's consequent encroachment, and it comes in at 27.75, and it trades through that today. And the top of that candle's opening comes in at 28.20, and today, which is my time, but it started a new trading day, the high comes in at 28.13, so just 6.8 pips away from getting to that high end of that candle here. And the close of this one comes in at 128.20 and 1 pipette. So again, it's pretty much along the same lines that this mentioned relative to this candle's body. So I think that we still could go a little bit deeper, at least trade up into this candle's close, which is the 20 institutional level. If it spreads and really expands up, we have a little tiny, little bitty fair value gap right there. If we trade above that, okay, if we trade above that, then we're really most likely going to take out the buy side liquidity here. Now, I'm not stating that's the likely draw from where we are right now. I'm just saying that it needs to get above this fair value gap for me to feel comfortable about these highs being taken out. And if it does that, I don't think it's going to go above these relative equal highs and then crash. I think that the dollar is absolutely going to get smoked and go lower. And this high here will ultimately be taken out. If these highs are taken out, this high is going. It ain't going to hold it back. But before it, we have the rejection block here, keeping in theme with the teaching today. So 1.3340 in 5 pip bets. That's ultimately a swing trader's target using institutional order flow. It doesn't require the high being taken out. But because we have the backdrop of these relative equal highs, I don't see it going up above here and then reversing. Okay, that's what I'm saying. So if it gets above here, that really is an indication that the dollar is in slippery slope and it can go a lot lower. And that's just going to allow cable to just go through the roof. But we have to take things one step at a time. We don't look at everything on a chart and say, okay, it's going to go 1,000 pips every time. You have to think everything through at a logical pace and see how everything fits together. And that's why this business is very, very hard, because it's not a matter of watch a video, put it to work, and you make money. Now, I can teach you how to do that with intraday trading because it's very short, it's surgical, you get in, get out, get in, get out. But when we work at these higher time frames, so many things can happen on a geopolitical level. I mean, look at all the riots and protesting that's going on. If anything pops off, on a grand scale, and say a Black Swan event comes out, which I'm expecting another one to occur, all this stuff is brewing, okay? And it's not good. None of it's going to be good. And something really terrible is coming. And when it does, it's going to send reverberations through all of the markets because it's going to be a shock to people. And that's what is the risk in using these higher time frame charts. That's why I'm not a position trader. That's why I'm not a swing trader. Okay, I am an intraday day trader, short-term trader, couple days, and I'm out. And if I'm holding for a one-shot, one-kill, I'm not holding a large percentage of my trade overnight into the next day, especially in the climate we've been in the last few years. Too many things can happen and just decimate the markets, and they can move a lot. So keep that in mind. And that's, again, answering a lot of emails because they ask me, if you can do all this stuff, why don't you just get short here and hold for this? Because it doesn't fit my personality. Like, I can see sometimes big moves like that, but I would rather engage on an individual basis, like sell it on this day's rally and then ride some of the range down, wait for this run back up into here, and then sell it and ride it down, sell it close to the opening here, ride it down, and I'm getting out and I'm able to sleep at night. Okay, I don't want to engage this market and hold for all this because it might not just be that simple. It may be a little bit more of a task, an arduous task to hold on to something like that. And it doesn't fit my personality. Like, I'm very short fused. I'm bipolar, and I can change my mind really quick, really, really quick. And if you're like that, I'm not saying that's advantageous or a handicap. I'm just saying if you're like that, you're going to find that long-term trading or swing trading is going to be very difficult for you. And I've also grown to appreciate short-term trading and day trading because the velocity of money is excellent using that, because I can turn equity faster doing multiple high-frequency trades versus I wrote all this out, I got 10,000 pips. I'm not saying that's 10,000 pips, but I'm just saying that folks online will say, yeah, ICT only makes these 20 pip trades, and that's not true. Okay, I can do 100 pips here and 100 pips there, 200, 300, all that stuff. But what most traders that talk like that on social media fail to realize is I'm looking for a multiple, an R multiple, every trade. And when it gives it to me, my equity increases. Then that R multiple increases exponentially too. So if I'm always getting a multiple that's constantly evolving and exponentially growing, they can hold on to these long-winded trades all they want, okay? But I'm still parlaying equity faster than anyone else. And that's what separates me, and that's what you're learning here. You have to start with this first. You can't just jump into, I'm going to trade a 1 minute chart and just destroy everybody. That's not what I was trying to imply by showing that. What I was showing is that the charts are not the secret. but I can find a lot of setups even with a 1 minute chart, and you can practice a lot with a 1 minute chart. But I digress. Back to the cable and the daily chart, because I have to wrap this up. It's likely that it will still go higher. Now, here's one of the things that I do like about what we have in the daily chart now. See this wick here, or tail? We traded down below Monday's low. We traded down below that, rejected it, and we expanded up today. To me, that implies that it's more likely, and I'll talk a little bit more about these types of things next week when we really tackle bias, because I really want you to understand how we can go in every single day and frame a bias, bullish or bearish, because it'll help you really refine what I taught on the YouTube channel. But because it did this move here, that means that it's more likely to trade above today's high tomorrow or Friday than it is to trade below this low here. Now, what do I mean by that? We've traded higher, okay, and just like we've wicked down here below this low and rebalanced this small little BISI, buy side and balance, sell side and efficiency. Again, this candle's high and this candle's low. That small little section of price action that is only made by that one single candle, this candle trades all the way back down to this candle's high, rebalances it, and then what happens? Price is allowed to go higher. Well, we don't have a fair value gap here, but we do have that same signature of running down below the previous day's low, rejecting it, and going higher the next day. When you see that, this is a run on stops. Anytime they run on stops and your bullish bias is still intact, which certainly looks like we're here, I would have expected this if it was coming down like that. It should have just started to work a little bit deeper. It didn't. That's why I'm saying that it isn't just a run above these relative equal highs and then it'll crash. I'm thinking it might keep pressing higher, and they may punish the dollar lower even more. But I don't want to sell the dollar going much lower, because it doesn't need to go lower in respect to what the cable can do. Cable always exaggerates whatever dollar does in opposite terms. In other words, if the dollar goes down 20 pips, cable can go 40 or 45. Okay, it just does more. It's always exaggerated. So if we are going to see a consolidation or a rather soft dollar, in other words, a failure to go higher on dollar but not really go lower, that still allows cable, or which is this pair here, British pound versus US dollar, to trade higher. And that's the other thing that makes this business a little harder too, because it's not always dollar down, foreign currency up. Dollar can go sideways and foreign currency can go down and up. So it takes a lot of understanding the core content here and lessons that I've yet to teach still. And then when you have all that, you get a better understanding of what price is more likely to do. And then again, you don't need 100%, but if you are 70% accurate, it's crazy what you can do. 60% accurate, you're crazy. It's crazy how much you can do. But let's roll into an hourly chart. All right, so here's the hourly chart on the British pound, and you can see we just fell short of that 28.20 institutional level. This low being taken out here is what I was talking about on that daily chart. I like that. It could drop down, clear this low, rebalance this buy side and balance, sell side and efficiency, that fair value gap, and maybe touch this down close candle in the form of a bullish order block. But look closely. See this candle here? It's one candle, and this candle here is one candle that's trading within this range here. So it went down and went up in one single pass, both down and up. This becomes a balanced price range. So it can go down to this order block, but it's likely not to do that. It could just go below this low and not eat into these two candles ranges. So what am I saying there? Look for, if it drops, look for this low to be taken out, but not in a big way. It could go down below that and then reject and go higher. Okay, in other words, this is likely to be touched, but it's not an absolute, where we make concession for it likely occurring, but because we have a balanced price range, and I teach this in the core content in the commentaries too, trust me, it's covered. So don't send me emails, especially the new folks. Some of you are new. You're already on email blast. You're saying, I need to know what this, and you have to keep a study journal here. It was in the enrollment. We tell you that even in the welcome message when you enroll. Keeping a study journal, anytime you have a question, you want to write that down in a topical format. In your study journal, if you have a question about Well, what's a balanced price range? Okay, that's a valid question. Write it down. And you're going to find there's a lesson or two as you go through the progression where I talk about it. And then I will use other lessons that you've learned and I draw more relationship to them, and it means more to you versus me saying this single down close candle here and this single up close candle here, because it moved between those two distinct price ranges, this level here and this level here. It becomes a balanced price range. What do you do with that? That's why you need to have the other lessons to support it, because I can't just say in one video that this down close candle and this up close candle creates a balanced price range, and this is the reason why and this is how you use it, because there's multiple things you can do with it. But as it is in this chart here, because we have a down close candle here, it's the order block that everyone thinks it's going to trade back down to, or they see this liquidity void. Okay, it's a BISI. I don't want this to be closed in. I want this low to be tapped and maybe traded down below a little bit, but on a shallow basis. And it could go down just below this candle's low right there. And that would be 126.94. So look for 126.94, 126.93, and leave this gap or imbalance in play and not touch the order block. Don't look for that to be happening. That's what I would look at. And if it trades below that, that would be something I could possibly, if it's inside of a kill zone, I could trade that on a turtle soup basis. Below here, buy the stops, and then wait for it to run up into that 28.20 and maybe expand a little bit more. That's one of the scenarios I would use with this balanced price range and the current market structure. All right, on a 15-minute chart, you can see, again, FOMC ran out the low, then ultimately pumped it through to take out the relative equal highs here. Same thing I've outlined on the euro dollar is existing here. They buy it, distribute above the old high. They buy it, distribute it above the old high. They take the low out here ahead of FOMC. Remember, this is that 1400 candle. At 2 o'clock, it opens, trades down, clears all the buyers, then runs, pumps it above the relative equal highs, and leaves the 28.20 level. They do sweep the 128 big figure, but it's only on a 10 pip basis. It's very shallow, and they broke it down here. So to me, it looks like they're enticing shorts. And if it does, okay, if it does go lower, we're looking for that low here, but not to get down into the order block that was on the hourly chart. Now, if it does trade down into the order block, it would be just reaching into this fair value gap there. Okay, and it becomes this candle here. So that high at 26.76 could potentially be a level it could react in. So how do you use that information? I personally would like to see a move to this level here and be a shallow run below it. Maybe even go 1 pip below it and then react higher. Wait for the reaction to go higher and create a fair value gap. Once it trades back down into the fair value gap, then do your practice there to see if you can get a run up into that 28.20. That's how I would personally trade it. You can practice if it trades below that low. You can do it as it hits the low or just below it. Assume that that would be your entry. And then use a stop that would be the mean threshold of this candle here. And that might be more pips than you're used to, but it's not important that you get a 5 pip stop loss because it's not realistic. Okay, all these guys on the internet saying they got 2 pip stops and 3 pip stops, they're liars. Okay, they are liars. Try that with a live account and they will dust you. Okay, so in here, be mindful of this level only on the basis if we have to trade back down to the order block, but this level here should not see a lot of downside. If it does, then it's probably going to be a deeper retracement higher on dollar and therefore a deeper retracement lower on cable. But I like the fact that this low went lower than this one, and there really isn't any imbalance because we already cleaned this one up here with this drop down. So see the candle's low here and the candle's high here. That is a BISI, buy side imbalance, sell side inefficiency, under the category of a fair value gap. It trades back down, rebalances it, and then it's allowed to trade higher. We have this same thing here is what's here. One single candle that the previous candle's high and the next candle's low defines that. Okay, so when you see my charts and it looks like these levels here, this is how I'm identifying the BISI or SIBIs. So that's what that is. Now, in this area here, it looked like that, but just on a smaller scale, and that's what makes this pattern fractal. And fractal is simply just saying what we see on one scale or size or time frame can be reproduced or replicated or similarly seen in another area, time frame, or scale. So this area here is the same thing that this single candle created. And notice how the bodies come down. We don't care about the wicks and tails. That's always going to be on the broker's end. That's where the spreads and individual brokers can widen it. The bodies is what we always study here. That's telling you the story. The wicks, that's always going to be liquidity, okay, that the broker is going to reach for. Their in-house liquidity. And perfect example of that is if you look at this candle's low, go across TradingView and look at Oanda's data feed, look at Forex.com, look at Saks, and look at Citi. Not that you can get all those on TradingView, but what I'm saying is go across and try to look at other platforms and their data, and their low won't be in agreement with that. And that's why we focus primarily on the bodies of the candles. We allow the trades to go against us to a certain degree because we understand that wick is inherent price action where it's part of the game. That's the risk. That's the inherent risk that's always associated with speculation. And it's not limited to Forex. It's everything that you trade. If it's trading, it has these underlying risks attributed to it. But this fair value gap and this fair value gap, it's the same pattern, same thing. So if it does trade down and it does basically this, that could be a potential turning point and reaction. We can see another one. Where did I see it at? Here you go. This candle's low, this candle's high. It trades down but doesn't completely close in the range. This is what I'm talking about. You want to see that type of reaction. I love seeing the imbalance left imbalanced. And I'll say that again. I like seeing the single candles that create a fair value gap left open. And if we start to see price turn and run higher, I'm really bullish in those instances because it helps having that there. Because if it was going to go lower, it should have did it right there or the next candle. And it didn't. It didn't completely fill in this one single candle. So what is that implying? If it doesn't want to go down there and close that in, is that bearish? Is that indecisiveness? Absolutely not. It's implying that the market is gearing up to make another run. At this moment right here, look to the left. What do you see? Relative equal highs and an old high rejection block. So there's lots of liquidity above these relative equal highs in the basis of this high and these individually. These are alone relative equal highs. But we have buy-side liquidity pooling, building up above these highs. Right there, because we couldn't even fill that in, the very next candle, look what happens. Energetic, boom, caffeine bar. Small little retracement, boom, one more time. Rebalances in here, and then pow. Buy-side liquidity tagged, buy-side liquidity tagged. Runs through it. Trades to the institutional 80 level, 127.80. Gears down a little bit. Rebalances that little tiny fair value gap. The same thing here is this here and what I outlined here. So right in here, the same thing. I'm just going to take these lines, and this is what we do. Okay, you want to look in price action for these signatures. This is what you're missing. This is what basically the retail books don't talk about because they don't know. But that little thing right there, that's the buy signals. It's not the indicators. It's not your overbought, oversold. It's not your divergence. It's not your zones. It's not your harmonic anything. Okay, it's very specific areas that your eye will be trained to being with me, and you'll see these things repeat over and over and over again. Now, think about the optimal trade entry for a moment. Okay, and then I'm going to wrap this video up. Here's your fib. Okay, so when price was dropping down into this area right here, think about the range it's inside of. It's this low and this high. So it's this low, this high. It's retracing back down into an area that's a fair value gap. So right away, you already know that this is the area potentially, if it trades down into it, it could be a buy signal. But what if we add some framework to it? So that's what the fib helps do. And I'm going to decipher what I meant on the YouTube channel when I said the fib only gives me a framework to help teach it to my students. So here's our dealing range. We have the high, we have the low to this high okay, and the price drops down. It needs to drop below the 50 level because then the market goes to a discount. And that means that it's where the interbank traders will trade. They will engage if it goes below the 50. When it goes below that, it trades into the fair value gap. And here is your 70.5 level. Bam. What's your projections? Well, you want to see it trade above this high. There's your targets here. And also, as I mentioned in the YouTube channel, these deviations, you can split them in half. And what do I mean by that? I'm just going to add one more fib. And this might be a little confusing to you, but just watch the video a few times. And when you get to price action model number 5 later on as a charter member, you'll see more about these types of things. So you have 128 and 6. So 128, 0, 6, and 8 pipettes. Okay? That's your mid-level between this level and this level here. And that's how we do standard deviations. So it's like a midpoint. 1.2806 and 8 pipettes. If we take that out and extend it in time, you can see that's where we hit. Again, think about how the wicks are always going to be the area where the brokers can do their dirty work and run on in-house liquidity. So Forex.com is the feed that I use always, so that way everyone can see the same thing when I'm talking about my charts and showing things on annotating my charts. So everyone that goes to TradingView, when they look at this particular candle right here at 14 or 2:15 p.m. New York time on June 10th, they will see the high is 128.13 and 2 pipettes. That's the reason why I'm teaching with this medium. We used to use Forex Ltd demo. They stopped doing business. We went to several other brokerage firms, and this is where we're all at now. Okay, so that's the reason why we don't use demo accounts anymore. We're just highly focused on TradingView. It's accessible to everyone. It's free, and that way everyone sees the same thing. But anyway, this level here is the midpoint. So every time you have a standard deviation, you can split that in half too. But you don't want to do any more splitting. But this is the split that you would do from here to here, that high. That's your old high, and then you have 1/2 a standard deviation. So when you split it, what you've done is you've created quarters. And that's why you don't want to do any more. You don't want to split it anymore. And in buying here, above this high, you can sell here. And the same thing we expect after it runs liquidity, it runs back above and takes out the midpoint or mid standard deviation between 0.5 and the old high that frames the fib. So this price range here retraces, optimal trade entry, take partials here, endure. And this is the reason why you don't ram your stop loss up. Okay, so your stop loss will be below here when you got in the trade. Did it stop you out here? No. You let it run. It has to run. And when it gets to the midpoint level here, it's a really nice opportunity for you to get out of it. Even if you use the rejection block, which is the highest up close candle here, that price is 127.91. Extend that out in time, it gives you lots of opportunity to get out above that here, and not even require trading here. So you want to get yourself accustomed to looking at where the levels could reach for, but find the low-hanging fruit. Where is it likely to get to easiest? And let your ego be soothed, okay, and fluffed up if you have to, if price gets there, and say, yeah, I called that. But get paid before it gets to those levels, because those levels, your broker may do these things here where the wick on the candles may trade just to it, but the spreads and things like that won't allow you to exit. Okay, so that's the part that I like to drive home when I'm talking about when you're doing your exercises, or if you ever transition to live funds. You need to be able to find the framework that allows the low-hanging fruit exits and be content with that. Don't think you're going to be getting in here and getting out at the actual highest high or the lowest low when you're short. That's not realistic. No one needs that. And you can find all kinds of setups with the meat in between. You're not going to get everything. You're not going to clean the bones. Okay, you're not going to pick the bones. Okay, that's what retail trading teaches you. To get in there and try to capture the tops of the markets or the bottoms of the markets and do all those like vultures picking every piece of the meat off the bone. It's impossible. That's impossible. You can't do that. No one can do that. I can't do that. No one else can do that. All right. Just find the meat, get your pound of flesh, and capture it within the scope of the run, the larger parent price swing, and be content with that consistency. And in building that exponentially over time, you'll never, ever, ever chase this top and bottom picking stuff ever again. You won't system hop. You won't have any kind of uncertainty as to what you're doing. You know exactly what you're doing. You know when it's likely to form. You know what it looks like, so that way you're not going to jump ahead and predict the setup. How many times have you done that? It might be forming that so-and-so pattern. Let me get in now, though, because I don't want to wait. I've done all that stuff before. What you're learning is highly specific. It's highly detailed. It's not ambiguous. It's very, very systematic. And these things repeat over and over and over again. So as the new students that have come in, welcome to the inner circle. I'm promising you, okay, if you give yourself the time and you absolutely study here, you're going to learn how to do this. You're going to learn how to read price, and you're going to be a market maven. Until this weekend, I wish you good luck and good trading.